Hey, Honest community. Before we dive into this episode, we've got a quick free favour to ask. If you enjoyed the Honest Property podcast, please hit like, follow, and subscribe wherever you're listening from. It helps us grow, reach more people, and bring on guests that you want to hear from. Thanks for being a part of this. We appreciate you more than you know. Hello, and you're listening to the Honest Property podcast with your hosts, Becky and Ruth. And we're sisters in property. We've built a multi-million pound property portfolio over the last 12 years, actually 14 years, longer than that now. And we have unfiltered chats about building wealth, purpose, and freedom that actually feels good to you. And today we're really excited to have Lisa Miller, is it? Miller.
Mela, yes.
Meller, Lisa Meller, and she is personal finance movement on Instagram, which is where we found her. But she's also, I also noticed that she was also on Female Invest, and she's just incredible and keeping investing and personal finance really, really digestible for anyone who doesn't really understand about compounding, investing, what on earth is an index fund. She has so much wisdom, and I just cannot wait to be able to get into this conversation because it's one that was really, really requested by our community and our audience. So, for anyone who hasn't come across you yet, can you give a quick intro to what you do?
Yes, absolutely. So I'm going to go back in time a little bit to kind of explain to how I got where I am right now, and give you a little bit of context. So I actually used to be a solicitor working in a very male-dominated field. And whilst I was working there, I realized that a lot of the people around me weren't really doing anything with their money other than saving it. And I got really, really interested in investing. I attended a lot of kind of networking events and webinars and stuff on investing. And then I decided to take the exams to become a financial advisor myself. And whilst I was doing that, I also realized that in the UK to date, only 16% of financial advisors are women. So it's a very, very small percentage. So there was sort of like a real kind of market out there for, being a woman in this industry and representing women and bringing investing to that community. So that's sort of my background. And now I'm really passionate, and I continue to be really passionate about financial education and bringing investing to, all kinds of people in all kinds of situations, really, and really breaking down some more complex, what seems like more complex topics into sort of easy, sizable chunks so people can actually get started and take those first few steps on their investment journey.
Well, what got you really interested in personal finance? Because everyone has like a beginning aha moment of what makes you really go, oh no, I need to understand this, or I want to be in the finance industry.
Yeah, so it was actually a combination of a couple of different things. So the first thing was that during COVID, I was still working in a law firm as a solicitor, and we basically got paid this COVID bonus. And I suddenly had this sum of money that I then needed to do something with. And actually, the first step that I took myself was to try and find a financial advisor because I was like, I don't know anything about this. I have very little time. I just need somebody to deal with this.
I
And
did
I
that
just,
too.
did you? And yeah, I'd be interested to hear what you sort of experienced, but I really struggled to find somebody who was sort of in the same wavelengths, who understood my position, who I felt like had my best interests at heart.
Mm.
And when I struggled to do that, I just kind of got to the point where, there was a few different Wells firms that I approached, and they sort of just all wanted to take my money and invested. And it didn't feel like they were going to explain very much to me about how it was going to work. And I also didn't really understand what their fees were. They were not very transparent about them.
Guilty. Same here. Yeah, same here. That happened to us too.
Did it? Interesting. Yeah. And that really then kind of made me think, you know what, this can't be that complex. I've got to just learn how to do this myself. And once I have learned it, it's then going to be like a life skill that is going to be super useful throughout the years.
Mm.
And that's what got me really fired up. And then kind of the second aspect, whilst I was studying, was that I then, when you're studying something new, I think you start talking to everybody around you about what you're learning. And I just found that so few people in my department at work knew what a stocks and shares ISA is, which is basically like the number one tax efficient tool in the UK to get started investing. And it was just so interesting because a lot of these people, had studied at Oxford and Cambridge. They were some of the most educated people in this country, in the UK, and they didn't know what a stocks and shares ISA was. And that then made me think, there's so many people who must not know.
I say
And
that
that's when I,
what is actually what interesting is that um, why, as a society, do we assume that people who are like the most educated people understand finance? That's what
yeah,
I find like where in our brain went that
I think
automatic.
I think it's because if you're going to go to a doctor, like you don't question them too much. Although I feel like nowadays people sort of do sort of question what we're being told more than before, even if it is a doctor. But with financial advisors, yeah, I agree. Most people be like, here's the money, do what you got to do with it without questioning any of the details. So I'm really glad that nowadays I feel like more and more people are starting to question like why things are the way that they are.
Yeah, I think this is a super, super interesting point, and I think actually, in truth, even today, there's very little financial education, in schools, universities, and it doesn't actually even matter that much whether you go to a state school or a private school. There's still very little in
Mm.
both. It is starting to come up more, and it is actually now under curriculum. So that's really, really
Good.
great. But it's obviously going to take a period of time until that sort of comes through. But yeah, it's a really interesting aspect why we sort of assume that some people might know and others might not. But I think in truth, actually, what you see when you look at some of the data is that actually it doesn't really matter too much where people have studied or gone to school. Actually, people who are older, especially now, they just haven't had that education.
That's so interesting. I would also say as well that when we were growing up, did go to a private school, but we saw a lot of like parents, they like had businesses, but then there was still no real discussion about finance. It was
Mm.
like growing in entrepreneurship, but like I've never really had those conversations, even with my personal friends, about finance or investing at all.
Yeah, and I think this is actually such an interesting aspect because I think there's a couple of things that come into this. So, firstly, as a country, we're super risk averse. We kind of get taught about saving a lot, I think, and then people sort of stick to that. And then I think also people are just really afraid of investing because there's so little knowledge that kind of goes around, and because we don't have those conversations, and it tends to be a bit of a taboo in society still
Yeah.
to talk about it, then we don't gain that knowledge from our peers either.
That's so true. We also have like lots of people who have who know that they should be investing, or they just don't know what to do with their money, but they don't act on doing anything. Why do you think that is? Is that basically because they think, oh, savings enough? Or like what is the psychology? Do you understand? Uh
Yeah.
yeah, I'll be curious to know what your thoughts are on that.
I found this aspect really interesting actually, and it's something I've been talking about whilst I was away in the last 4 weeks a lot because I was in the US and the data in the US is so different. 60% of the US population invest versus 30% in the UK. So
Wow,
it's
that's
like
huge.
really different. Yeah, so, so interesting. And actually, in the US, it's a really common like topic when you're having friends over for dinner to talk about what stocks you've picked, whereas that's not something I've ever seen in the UK. So I think there's a lot of
That is so
structural issues.
interesting.
Wow, that's
Yeah.
a fascinating fact. Like I did not because it makes
Such a huge
sense.
cultural difference, isn't it?
Yeah, it really is. It's so interesting. I think it's very structural because it's that element of education, but then also risk, and the money taboo and so on that kind of all feeds into that. But I do think, in Europe in particular, various countries, not just in the UK, but we have this like huge thing that we need to save. It's kind of almost like a sort of post, I know this is a very long time ago, but it's sort of a post Second World War mentality that we need
Yeah.
to save our money and that's like the thing to do. But then we don't really learn very much about inflation other than what it is, but you don't really think about what it actually means for our money. And
Mm.
that's, I think, where it maybe comes from a little bit. I don't know, I'm not an expert in that particular area, but that's sort of some of my observations that I've had from other people.
Now that you
That's
said
really
that,
true.
I would say as well, like when the first time I ever heard inflation, it was always like a bad thing because until like you understand how your money and compounding and all of that works, then you go, oh, inflation, that can also be a good thing. And I
Yeah, I
just
mean
find it,
that's how the economy grows, right?
yeah.
People always like when you start explaining what inflation is and you say, it devalues your money over time, people are always feeling very negative about it. And then your second sentence is sort of like the target in the UK and EU is 2% for inflation. We want prices to increase by 2% a year. And then people kind of go like, but why? This doesn't make any sense. And then you sort of have to explain that we need prices to increase over time because the world population grows and as a result, the world economy grows. And so, exactly, you're absolutely right. It's not as simple and black and white as saying it's just a negative thing.
I do have another, and I'd love to just want to pick your brain on this one as well before I ask my other questions. But do you think, personally, do you think that maybe the reason this is because maybe there is more American uh, uh
I think I know what you're going to
financial
say.
wealth
Content.
content
Yeah.
online compared to based in the UK?
I think that could be one of the other reasons, and I think, of course, there's so many different aspects, such as, for example, that people in the US, in relation to their expenses, get paid a lot more money, and that means they have more disposable income. And when you have more disposable income, the thought process that you sort of have is similar to what I had when I got paid my bonus. You're like, okay, I don't really need this money, but what do I do with it? And I
Mm.
think obviously if you have that disposable income, that just naturally happens a lot earlier. Here we just have such a high cost of living now in relation to the amount that people earn that, a lot of people literally live paycheck to paycheck. And that's not necessarily lack of knowledge, but just it's just not really possible to save or invest anything. And then it just doesn't even become a thought process.
It's so true. I see fintech, sorry, like what are they called? Fin Financial educators online. They're as young, they're American, they're as young as 20. And I just think like you just don't really hear of young Brits talking quite in the same way about finance. So at least they're influencing us in a positive way. I think we can learn a lot from that influence and try and apply it where it counts in the UK.
Yeah, definitely. I think that's so true. The internet has, and social media in particular, certainly opened up and simplified getting started with a lot of these things. Like you can even see this development as well in terms of the actual practicalities of investing. Because if you had asked like 20 years ago, for example, the only way to invest would have been through a financial advisor or bank, right?
Mm.
Whereas now we have all these fintechs that actually give us access to the markets and allow us to go and pick our stocks ourselves and invest from like £1 and invest regularly only £25 a month. And I think a lot of people aren't really aware, especially in the UK, that actually you can get started with such small amounts of money. They sort of have this idea that you have to already be very wealthy to get started, which is another hindrance then.
On that note, if someone is starting from scratch, what's like the first thing that matters the most?
Yes, great question. So, before we kind of dive into investing, I think it is really important that we say that the first thing that you actually need to do is build a solid financial foundation. And that means having what we call an emergency fund. So, 3 to 6 months of your expenses you should keep in cash. A lot of people find this quite difficult to save because it tends to be quite a large sum when you actually calculate it. So if you sort of start off with 1 month, get to like £1,000 or so and then build it up, that's like a really good way of doing it. And then once you've got that, it's then all about kind of educating yourself about investing, which I know sounds like a really broad thing, but there's actually just a few principles that you need to follow. And then it doesn't actually matter a huge amount what kind of investments exactly you go for. So this is really, really interesting. I don't know if you've come across this study before, but actually in the US there was a study where they got monkeys to pick stocks, and they also got professional investment managers to pick stocks. And actually the monkeys outperformed these investment managers. And
Hilarious.
I know it's funny, isn't it? And it kind of shows us that actually what we invest in as such isn't so important. It's more about the principles of investing, such as diversifying. So not just investing in one thing, but a number of different things, investing over long periods of time, investing regularly and so on are much more important than picking that one stock that is going to make you lots of money.
Yeah.
Yeah, yeah, it's true. I think it's so easy to overthink it, isn't it?
But I have also spoken to other people who are in their 30s who have also said that they feel like they're too late. Is that true?
No, absolutely not. I often get this question, even from people who are like much older, like in their 70s. It's never too late as long as you have at least 5 years to invest. And your 30s are still a great time to get started investing. You've got so much time. You've got like
Yeah.
30, 40 years. So absolutely not. That said, of course, if you had started in your 20s 10 years earlier, you'd probably be a lot richer by now. But starting in your 30s is definitely not too late at all.
No, yeah, I think maybe because you can see lots of younger in like people who are finance influencers online, they seem a lot younger, they're just a bit more confident to put themselves out there online. But it doesn't necessarily mean that just because you're in your 50s, 40s, whatever age it is, you'll find a way to invest that it will fit when when you want to retire at one point. You don't have to think that you need to be a 20-year-old investing and that's like your only time that you can. So I think that's really helpful because there have been people that have spoken to me that said it's just not for them, or they feel like they should have done it in the like when they were it's like real or meme, or like when they should have done it when they came out the womb.
Yeah, I mean, I think that is an interesting aspect because I think it's such a powerful tool investing when you have time. And certainly, from your 30s onwards, you still have a lot of time. But also, there's something to be said for, this kind of dives into a little bit investing for children. It's really, really interesting because in the UK, for example, we have a junior stocks and shares ISA that allows parents to invest on behalf of their children up to £9,000 a year, a tax year. And if you actually invested in their pension, you've also got an additional £2,880 that you can put into a junior pension for them. And if you literally just invested that from year one when they're born to when they're 80, and then they added nothing else, so £2,880 a year, and then the government adds tax relief on top of that, they add nothing else. By the time they retire in their 50s, they will be a millionaire in their pension
Wow.
just by having that money
Wow.
invested.
Yeah, this is so important because I didn't know about this stuff. And when I had my son, he's 4, will be turning 5 this year. Straight away, I was like, I need to look for something that I can start now because we started when we were 20. And so I said, there must be a product out there that allows you to start from even earlier. And yeah, so there is like look at like especially in the UK, that's like that's a big benefit that you can start as soon as your child has is registered born.
Exactly, that's it.
So I want to talk a little bit as well about just investing, especially into the stocks. We're all about property. We talk a lot about property and just business in general, but actually we don't talk enough about what like an ETF is, because people hear what that is all the time, but they don't actually, what does that mean if you can break it down in simple terms?
Yes, absolutely. Okay, so ETF actually stands for Exchange Traded Fund, and it's basically a fund which is in itself traded on the stock market. Let me break that down a little bit more because people might not know what a fund is, right? So I think the one thing that we all know that you can invest in on the stock market are individual stocks. So for example, I can go and I can buy a share in Apple, right? Not an investment recommendation, just an example. So if I buy a share in Apple, then I only own that one share, right? So if something happens to Apple, then immediately we can start seeing that our investment could go down or up, depending on what happens. Now, that's quite a risky thing to do because you're putting all your cards onto the same thing. Whereas essentially, when you're investing in a fund, the fund itself is one investment which contains a number of different stocks. So by investing in that one fund, I'm then automatically investing, for example, in the 500 largest companies in the US. And that would be following an index which we would call the S&P 500. Now, we can have funds that are on the stock market, like ETFs, and funds that are not on the stock market, which we call usually mutual funds. So
Mm.
ETFs are super easy to access because they're on the stock market. So you just literally open like a brokerage account, an investment platform, and it will be there alongside things like Apple, Nvidia, and so on. You will also have an ETF on there that you can then invest in. And the really beautiful thing with ETFs is because they're on the stock market in that way, usually the kind of entry amounts of money that you need to use to get started are really, really low. So they're very popular because they're diversified already and you can get started with very small amounts of money.
Wow, that's amazing. Because why maybe because we're already in this sort of space, my head goes, well, it's a no-brainer. But
Mm,
I'm trying to understand, why do people still fear something where you've explained so well? Why do people still, I've been trying to put myself into someone's shoes who doesn't understand much about investing at all. Why is there still such a fear, especially with women?
yeah, so interesting this. And I think it's all to do with loss aversion. So, when you invest in property, for example, obviously, you're always hoping your investment is going to go up over time. But even when you're negative equity, you can't technically see it unless you sell that property, right? In a savings account, your money can never go down, really. So even though you could lose money in relation to prices increasing, so your money basically buys you less in a year's time than it does today, you can't see that happening.
Mm.
But with investing, your money can actually go down below the original amount of money that you've invested. And I think that is what scares people so much. And
Because you can see it.
unfortunately, you can see it exactly. You can see the red figures. And unfortunately, all of the regulators all across the world have terms such as capital at risk, which basically means you can lose the entire amount of money that you're investing. That's what they're trying to say with that sentence. And that really scares people.
Yeah,
But the
the
truth
language.
is, exactly, but the truth is that actually, if you're well diversified, the chances of losing every single pound or dollar or euro that you're investing are actually pretty low. But nobody
Mm.
really tells you that. So I think it's loss aversion that people are really, really, yeah, kind of triggering when they're sort of going into that.
That was really well explained, and I don't know why I never thought that makes so much sense now, because it baffled me why people wouldn't invest, but they would save. But now that you've said it like that, I'm like, oh, okay, no. I mean, you don't know what you don't know.
Exactly. Yeah. And that's the other thing. I think that's a really interesting aspect that you've just brought up. So I think the like feeling like you have a lack of knowledge or like it's complicated
Mm,
is just another hurdle. It sounds easy like this. So if you went onto like, a brokerage account and it only had like three ETFs, most people would probably be okay to put some money into there. But
yeah,
when you go into there and it has like 10,000 different investments, I think it just overwhelms and it's
yeah.
just difficult, like knowing what to choose, just even understanding how all the different products work, even identifying an ETF, which by the way, you literally do by the name, it will have the letters ETF in the name. But again, people don't know that, right?
No. So why do we know some property investors that lean towards index funds instead of picking stocks? Why do you think why do you what why is that? Because it's just easier to manage.
Before we continue, here's a quick thought. Ever feel like there's just never enough time to focus on what really matters in your business? You don't have to do it all alone. As they say, a great team makes everything easier. That's why we've partnered with the Freedom Geek. Their talented Filipino VAs help us with tasks like admin and podcast editing, just like for this episode, giving us the freedom to focus on what really moves the needle. If you're looking to reclaim your time and to work smarter, then check out the Freedom Geek. All the details are in the show notes. Now let's get back to our conversation.
Yeah, so I think it's actually a lot about the initial research as well. So when you're researching ETFs or mutual funds, then essentially, you just have to pick one that either covers the whole world, which by the way is usually called an all-world equity ETF, or you would pick different indexes that represent different countries, for example, like one for the UK, one for the US, one for, Europe, and so on. Um, and that's fairly straightforward because usually when you go onto a platform, there tend to be only like two or three options of each of those. So that's
Mm.
pretty easy. But when you actually stop picking, if you do, like, imagine you don't know anything, it's really hard to know, is Apple a good investment? Should I put some money into Microsoft or actually Google? Or do I stay clear of all of these big companies and go towards smaller ones? And as somebody who doesn't really know what they're doing, it's just really hard to actually evaluate whether something is a good investment when it's an individual company.
I was going to say that actually is of what mistakes do you think the big anyone that is a beginner makes early on? And is it basically analysis paralysis?
Yes, that is like the number one mistake, honestly, that people just don't get started. They sort of know that they need to do something, and they even set aside like sums of money to do this, but then for like sometimes years, they don't take any action. Like I often see clients who've literally held like £200,000 in cash for over 20 years because of this exact issue.
Yeah.
It's so much money, right? And all of us sitting here obviously know that that would have just lost so much value in that time. But again, when you're somebody who's a little bit fearful of losing your money, you don't really know what you're doing. I think it's quite easy to get into not doing anything.
Yeah, because I know so many people who don't invest at all, and I'm just it's oh yeah, there's just so many people that don't invest that I know. And but my brain goes, I still like don't understand why, but it is just knowledge at the end of the day, isn't it? And maybe with the stock market, it's so much a what do you call it? It's a easier path to get into investing and get compounding straight away that I I still never fully understand why there's such a mental barrier. I can't especially with my women friends. Especially with my women
Mm,
friends. Like I don't really talk to any men
I would
unless they're
say,
in yeah, sorry, May.
I was sorry, butting in, but I totally agree with you because when I talk to guys about stocks and shares, they're a little bit more open to talk about it, but they tend to talk about it more in terms of I picked one individual stock and it's like
Yeah,
Tesla or
yeah.
Apple or something. They'll focus. They tend to focus on an individual thing or be like, you need to, or like have a suggestion. Whereas, yeah, 100%. When I talk to women about it, it's not really a topic that anyone's really interested in having conversation about.
yeah. I think there's also a little bit of a societal aspect where, obviously talking about money in itself is a bit of a taboo, but also when, girls and boys are much, much smaller. So literally talking about when they're like 6, 7 years old. At 7 years old, you form your first money mindset, right? And as a society, unfortunately, we do tend to, and this goes across all different aspects of life, actually, we tend to teach boys to take risk and we tend to teach girls to kind of like save their money and make sure that they've got some money there. And that sort of feeds into like some of the behaviors later on as well, where still to this date, there's a lot of marriages in particular, where, men will basically deal with all the money. And women don't really know what's going on until they get a divorce.
God, that's so true.
You put a post out recently, and I thought it was really good about how most financial conversations focus on growth, and it kind of misses out. I'm thinking this post is like it misses out on how to protect what you have as well.
Yes.
Um, I think it made me go down the tangent of like, okay, you are typically a lot of people who are in a partnership, they have a partner, a romantic partner. How like that is a whole new world in itself, how to manage it. And you're right, it's usually the guy that tends to um, be the head of the finance in the household. Are there things that regular people should really consider in day-to-day life when it comes to protecting their real life household money setup, if that makes sense.
Yes, absolutely. And I think that's such a great question as well. Before I answer this, I just wanted to say something which I think is really interesting, which is actually when we look at data of same-sex couples, we do not see that dynamic. So it's a very social conditioning sort of thing, that this happens over time. But yeah, in terms of protecting your position and your assets, so I think everybody should have their own emergency fund. Even if you have a joint account together, that's great for your joint expenses, but you need to have a separate emergency fund. You also want to make sure that you've got your own pension savings as well, right? Often women tend to take career breaks, for example, because they're caring for somebody or because they have a child at some point. And whilst in some countries there are laws in place where employers still have to make pension contributions, they tend to be lower and based on the maternity pay rather than your usual salary. And obviously, if you're the one who's actually caring for your child, you should be entitled to still getting those pension contributions. So actually having those conversations with your partner and making some arrangements to make sure that the situation there is fair and you're not sort of losing out on those years. Because again, the data kind of shows us that when it gets to like older ages, women tend to have less than half of the pension savings that men have. And this comes from those years, right? So it's about having conversations about money in your relationship and coming to like equitable solutions that work for both of you.
Yeah. I mean, there's also maybe something else to consider is uh just like my two peas, 2 pence. Is that right? I don't know the sayings. Um, a prenup agreement is not necessarily a bad thing to consider, I don't think. It doesn't kill the romance in anything. It's just like an insurance policy for your relationship. Um, and maybe even a what's it called? Common tenant, like what's it called?
Tenants in common.
Mm, not tenants in common, but I mean that is another thing. When people move in together, they
Cohabitate,
buy a
yeah.
house together, and they don't really consider like if things were to go south, like what is the split of this house? I've seen many situations where people buy houses together and everything is in just one person's name, and
Mm,
then the other person's left with nothing, even though they put so much effort and energy and paid towards the mortgage of the house for a long period of time. So yeah, there's a lot of like real world examples that people just don't talk about because it's taboo or it's not romantic.
Yeah, definitely. I think that is so interesting, and I completely agree with you. I think prenups are a really good idea. Of course, the one issue that we have in the UK is that they're not legally binding, but I think it's still worth it to do them because
mm,
it opens up that conversation that we've just been talking about, where you just discuss what you want to happen. So I totally agree with you, and I think same with home ownership and stuff. Just having that discussion on what would actually happen if this relationship was going to break down and then what are the next steps we would both be happy with, because if you discuss that when you're in a good position it just makes it so much easier when you're not, I think.
Yeah,
um and this brought to my mind just one other thing that I think, in terms of like protection is really, really helpful, which is also insurance. So things like life insurance, for example. So not necessarily the scenario of the relationship breaking down, but more, people get serious illnesses a lot more these days, passing away unexpectedly, and then making sure that actually you're still going to be able to pay the bills and so on. So having life insurance in place, especially if you've got kids or mortgage, for example, then thinking about those things as well.
So yeah, that's so true. I think it wasn't until I had a kid where I started getting really serious about like all of the different insurances and investing for him and going, what are all the steps I need to do so that if anything was to happen to me, like even wills and yeah, just all the like the boring legal important things. And you're either going to have that conversation, you have the conversation now and let it be a bit uncomfortable. Like even with what you said, because I didn't even know that a prenup was not legally binding in the UK until only recently. But I thought actually that's brilliant because it makes the uncomfortable conversation happen at the beginning, not at the messy end, or when you're severely sick with your life and not having life insurance, that you can't protect your family. So you may as well have all those uncomfortable truths happening right at the beginning so you know where you both stand in the relationship.
Yeah, I completely agree.
We're
Yeah.
obviously both in the property world, and you're more in the markets. So, what do you interested to know about your opinion on diversifying asset types?
Yes, yeah, that's a really, really good one. So I actually have a lot of clients who invest in property, for example, alongside having a portfolio in the stock market. And I think, that can be great. I don't think there's anything wrong with that. I think it's a great idea to have different asset classes from things like gold, property, even having some cash as well, having your investments and really being diversified across them all. The one conversation that I always have with people is just understanding returns. So, starting off very simply, if we look at a current account, we get nothing in terms of interest, right? If we look at a savings account, at the moment, we're looking at around sort of like 3, 4%, depending on what accounts you're looking for. When you're investing in things like bonds, then we're at around 4 to 5%. And then typically, when we're looking at the stock market, we expect returns of around 8 to 10% from a diversified portfolio that has at least 60 to 65% of equities, so stocks in it. Now, what we then want to do is kind of compare that to the returns that we're getting with the property that we're looking at, right? And of course, with property, there's two sort of income streams. So we have obviously the capital gain, but then also we have the income, whether that's like Airbnb, long-term let, whatever it is. So it's about kind of like adding that up together and then understanding what your return per year on average is, and then sort of just comparing that, I think, to the other streams, and then deciding whether it's worth the effort or not for each of them.
Yeah, because I do find it because we are in the property world and all we see there's like die-hard people for property or die-hard people for the stock market. But why do you think that people get so attached to like one strategy? Or is that just social media influencing that's the right thing, the only thing that you should do? Because we're very much about diversification and not just going just because we're the property sisters, honest property sisters doesn't mean that like that's all we think you should do.
Yeah, yeah, it's so interesting. I think it's a lot about what you grow up with, because I think when you're in like an environment where your parents, for example, invested a lot in property, you just kind of like grow up thinking that that's the only thing to do. And again, like we said, because there's so little education on all of this in schools and universities and so on. You just don't, if you don't really like hear about how the stock market works, but your parents have always invested in property, I think that's just naturally the route that you go down. But yeah, some people especially who teach, I think in various different, whether that's about investing or whether that's about property and so on, they just tend to be quite set on one of the things. But I think looking at it from a returns perspective is just like a really neutral way. And I think obviously the second thing that comes into this is how much time you're spending on things and the value of your own time, which is something that people do not often think about when it comes to investing as well. Because if you spend like 10 hours researching which stocks to invest in, then you really got to ask yourself whether the return that you're getting for that year is still worth it in relation to the time that you've been spending as well. So, and I think the same goes for property as well.
That's
That's so
true.
true. That's
One
so
is certainly a lot more hands-on than the other one, but I think in terms of leverage, you can earn more faster with the more hands-on option.
yeah,
But
it's
I think,
basically the higher risk tends to be, we were talking about this before we came on the podcast, but it tends to be uh like the higher risk, there's more work into it.
Yeah, that's so true, isn't it? And I think it's interesting because we've mentioned earlier that if investing in the stock market, you should be invested for at least 5 years, and it's sort of a very long-term thing. Whereas I do think with property, there are some strategies that enable you to make money quicker. Like if you're buying something, refurbishing it, and selling it, you can do that quicker, right? That's not really possible on the stock market. So it always really depends on your personal situation, what other assets you already own, what your plans for the future, what you need as well. If you need an an income from it or not. And I think this again, when we're looking at property, the income, the yield that you tend to get tends to be higher when you want an income than when you're following a dividend strategy on the stock market, where you tend to get about 4%, whereas with property, you can make more than that in a year. So it's just like really depends. And of course, for somebody, for example, who's got a really big income already from their salary, alone from a tax perspective, it just doesn't make like a load of sense for them to then get this bigger income from property when they could actually make a tax-free capital gain on the stock market in a stocks and shares ISA. So
Mm.
it's so dependent on the person as well.
It's so interesting because I've been listening to a lot of different people who have been in the property industry for a very, very long time. Like they're like yeah, since the 80s, like probably even before, and they're all at a point where they are, they want to enter more into the stock market. And I wrote about this actually in our community, and that it's so into you basically decide when you're older and you're probably nearer retirement, you're not going to want to carry on doing a high risk strategy, most likely. You're probably wanting to kind of calm down a little bit. And at that point, you're wanting to diversify your and lower your risk in your investment portfolio. So you're more, I've seen people more wanting to put more of their money from their like selling their properties at that point at retirement and putting it more into the stock market, but in a very diversified portfolio because that was like the right time for them.
Yeah. I think that makes so much sense also in terms of liquidity, which is something we
Mm.
haven't actually talked about that much yet. But of course, with the stock market, you have so much liquidity that you just don't have with property when your money is tied up.
Oh
You can
yeah.
literally sell, and in 2, 3 days, you can get your entire amount of money back.
Oh,
Obviously, it
I
can
could
go
ask
up as well
actually.
as down, but yeah.
Well, could you explain to our audience what liquidity and illiquid means?
Yes. So it's all about how quickly you can turn your investments back into cash that you can then spend on something else. So I don't know, say for example, washing machine breaks down and you need to buy a new one, right? You shouldn't necessarily sell your investments for that. But if you have a specific investment for that that has been going for years and years and years, right? And you know that's where I'm going to sell down from, again, you can access that money in 2 to 3 days. If you had that money tied up in a property, you could not get to it unless, you're remortgaging or you're selling and so on. So is quite different in that aspect. So it's a really helpful strategy, exactly like you said, when you're getting close to retiring, because that tends to be a time when you want to take some income from your investments, but you don't know exactly how much income you want to take, because there's going to be maybe a couple of years where you're going to travel a lot and you're going to want more money. And then there could be a few years where you're tending to the garden and seeing your family locally and you need a lot less money. So it just gives you that flexibility to take as much as you need at the time, whilst the remainder of your money still continues to grow as well.
Yeah, that's so true. Yeah, I think people don't really talk about that enough of there are different each asset class has different trade-offs in investing, but that's why it's so important to diversify, and that's why we wanted to have this conversation with you because like we said, we're not just about property. We care a lot about people being diversified in their wealth portfolio massively. I do have some questions from our community that did wanted to ask, which is hypothetically, or theoretically, if someone had 100K tomorrow, how would they think about what to do with it?
Yeah, really great question. So I think the first question to that person from me would be, do you have your emergency fund in place already? If they do, then it's really about what to kind of do with the money and a large chunk could then go into investments. But my second question would be, do you need any of it in the next 5 years, for example, to buy a property, right? And if you need some of it for deposit, you want to keep that money in cash. If you don't need any of it in the next 5 years, you can actually invest the entire amount of money. And then it just depends on your investment horizon and the vehicle. So, for example, if you want some of it to be for your retirement, it would go into like a self-invested personal pension, for example, a proportion of it. If you need to access some of it earlier, whether that is to put your children through a private school or to go traveling or take a career break, you could use the stocks and shares ISA, for example. And then for any remainder, you could also look into a general investment account where we also have some tax allowances as well. So it just really depends on that person's circumstances. But I think it's a really good idea in terms of a little piece of advice here to just give yourself like a couple of weeks with that money to decide where you're going to put it so that you don't end up just like spending it. So chucking it into like
Impulsive.
a savings account, exactly, and really like deciding what you want to allocate the different funds to.
That's really good. Yeah, that's really good advice. And another question is would how should people think about investing versus paying down debt?
Yeah, great question. So this is kind of all about rates again. So earlier we were talking about rates of return and we sort of established what some of the rates of return are of different asset classes. Now, when it comes to paying down debt, we sort of want to do the same thing. So we want to look at the interest rate and we want to see at what level that is. Typically, when it tends to be 5% or below, then you tend to make more money with investing, although of course your gains are never guaranteed with investing. But we talked about earlier, the historical average US market stock market return of 8 to 10% a year. So obviously that would then outperform the interest on that debt. If you have any debt that's higher than 5%, you do need to think about whether you do want to pay some or all of it back before you actually invest that same amount of money, because then essentially you're kind of risking not being able to outperform that interest rate with the rate of return that you would get from your investments.
Yeah, that's such a good answer. Yeah.
We always
Um,
like to, we're coming to the end of this episode, but there is just so much to unpack here. Um, we could go on talking about this topic forever, but we always like to end on this question. We love to ask, I guess, this question. So it basically is, and there's no, it doesn't even have to be about stocks or shares or investing. It could be literally, your answer could be literally about anything.
anything.
So the question is, honestly, what's the biggest lesson you've learned when it comes to money or building wealth?
Yeah, great question. So I think it's that you shouldn't look away and not do anything about it. So inaction is still a decision and it still has very serious consequences. So I think it's just about paying some attention to it regularly, at least once a year, and then kind of, doing the right things at the right moment in time of saving, investing, saving for your children, and so on as well. So not to not take any action effectively.
Yeah,
Imagine being the guy or the girl who had that 200K for that long and didn't do anything with it. Just,
Exactly.
yeah, you don't want to be that. Thank you so, so much for sharing your insights and wisdom. And just like it's so, like Ruth said, it's so digestible, so easy for normal people to understand and just apply it. Because the trouble is it's not like people think it's more complicated than it is, but you break it down in such a way that people can take action now, which is really fantastic.
Thank you so much. And thank you also for all of your amazing questions. They were really, really great as well.
Thank you,
Thank
Lisa.
you,
Where can
Lisa.
our audience find you?
Yes, so the easiest place is probably Instagram, and our tag is personal_finance_movement. So really easy. And then on my website as well, which is just personalfinancemovement.com. So super easy.
Perfect. Well, we're going to put that all in the show notes when this episode comes out. Thank you so much, Lisa. We've really enjoyed it. And yeah, we could talk for ages with you. You have so much amazing insight into this world, and I'm just really looking forward to more people starting to wake up and realize that they are sitting on yeah, their money can work a lot harder than it is right now. But thank you.
Amazing. Thank you so much.
Bye.